Joe, forex day trading. 5 strategies that actually work. Most traders pick the wrong one. Here's the fix. Here's the number that changes how you should think about forex day trading. Across regulated brokers, 70 to 85% of retail accounts lose money. That's not a strategy problem, that's a regime problem. The strategies themselves work. The traders are using them in the wrong market conditions, and that mismatch is the single biggest preventable source of retail losses in this market. Day trading forex means opening and closing inside one session, minutes to hours, then flat. No overnight hold, no rollover swap. There are 5 strategies that cover almost everything retail traders actually run. Each one fits a specific kind of market. Pick the wrong one for the day, and a system that's been profitable for months suddenly stops working. So what are the 5? First, trend-following breakouts. You mark a session range, usually the Asian high and low, and you enter when price breaks it with momentum. Stop inside the range. Target 1.5 to 2 times the range height. This works because institutional flow and liquidity providers cluster around obvious technical levels. It fails badly in chop. Flip the logic and you get range trading. Fade the edges of a support resistance band with limit orders, small fixed stops just outside. This works in quiet conditions and dies the moment a real breakout takes hold. Then there's mean reversion. Price moves a defined distance from a 20 or 50 period moving average and you bet it returns. High hit rate, small wins relative to losses. When it fails into a trend with no warning. News trading is the violent one. Trade the spike around NFP, CPI, or central bank rate decisions. Wide stops, tiny size. And finally, scalping. Seconds to minutes, 3 to 10 pips a trade. Dozens of trades per session. Each one has a market it prints in. Use the wrong one and you bleed. Now the part nobody talks about until it's already cost them. Day trading P&L is hypersensitive to costs because your trade frequency is high. 2 costs matter most: spread and slippage. On a standard market maker account, Euro-US dollar spreads run 1.0 to 1.6 pips, no commission. On a raw spread ECN account, you get 0.0 to 0.4 pips plus $3 to $5 commission per side per lot. Sounds small, it isn't. A scalper doing 30 round trips a day on one standard lot of Euro-US dollar pays $240 a day in spread on the standard account. On the raw spread account, $80. That's a $3,200 a month cost gap for one trader. And spread is only half the story. Slippage on stop orders during fast moves can quietly cost more than spread itself. A broker with a 0.2 pip spread but 1.5 pip average slippage on stops is more expensive than one with a 1.0 pip spread and 0.3 pip slippage. The headline number lies. Track your slippage in a journal or you're flying blind. Here's the part where most retail traders silently fail. Position sizing. Risk no more than 0.5% to 1% of account equity per trade. Cap daily loss at 2 to 3%. Cap weekly loss at 5%. When you hit it, you stop. No negotiation. The math is mechanical. Account $5,000. Risk per trade 1% equals $50. Stop distance 20 pips. Pip value on a Euro-US dollar standard lot $10. Position size equals 50 divided by 200, which equals a quarter of a standard lot. Drop the account to 1,000 and the same math gives you 0.05 lots. Drop it to 500 and you're at 0.025, and not every broker even supports that granularity. Below roughly $1,000 of risk capital, position sizing becomes too coarse to manage risk on a 20 pip stop strategy. That's not opinion, that's arithmetic. Risk management isn't an add-on to your strategy, it is your strategy. A profitable system with broken sizing produces a blown account. So when does each strategy actually fit? Forex has reliable intraday rhythms. The Asian session, 2200 to 600 UTC, is quiet, good for ranges on AUD, Nearly Van Dollar, and the yen crosses. London opens at 7 and volatility expands. Breakouts work here. The London-New York overlap, 1300 to 1700 UTC, is the highest liquidity window of the day. Tight spreads, deep books. This is where scalping and breakout strategies on Euro-US dollar and GBP-US dollar do their real work. After 1700, liquidity thins and it gets choppy. Avoid. Euro-US dollar is the default pair for a reason. 60 to 100 pips daily range. The tightest spreads on the planet. Predictable session behavior. GBP-US dollar moves more. 80 to 120 pips a day. At a slightly wider spread with more headline risk. USD-JPY is its own animal, driven by Bank of Japan policy and US Treasury yields. Exotics like USD-TRY or USD-ZAR walk away. Wide spreads, gappy moves, slippage on every fill. The economics rarely work for retail. And then there's the economic calendar, the single most important external input you have. NFP, CPI, FOMC, ECB. Check it at the start of every session. Trading into a major scheduled release without a plan is the most preventable source of large losses in this entire business. You have three real options. Stand aside. Close 15 minutes before, re-enter 15 minutes after. Pre-position a straddle with stop entries above and below the pre-release range. Or wait 5 to 15 minutes after the release for direction to clarify, then join the established move with stops outside the initial spike. Most retail traders find option 1 or option 3 more sustainable than fading the headline. The reflexive trade the spike approach is the most lossy thing you can do in Forex. One more thing to understand before you pick a strategy. Each one has its own statistical profile, and confusing them will torch your psychology. A London breakout strategy wins maybe 35 to 45% of the time, but the wins are 2 to 3R. You lose more often than you win, and the winners pay for the losers with change to spare. Range and mean reversion flip that. Win rate 60 to 70%, but the wins are 0.7 to 1R, small. One badly placed loss erases 3 or 4 winners. Scalping is high hit rate at 55 to 65%, but the wins are 0.5 to 0.8R, and you're paying spread on every entry. The mistake is expecting a breakout trader's psychology to handle a scalper's win-loss rhythm, or the other way around. Match the strategy to your temperament, not just to the market. So here's the framework. Pick one strategy, one pair. Demo for 30 sessions with realistic sizing, not for P&L, for process. Then transition to micro lots with $2 of real risk per trade. Track 60 or more trades before deciding the strategy works. Anything shorter is sample noise. Keep the journal. Every trade. Entry, stop, exit, slippage, thesis, lesson. 3 months of that data is more useful than any course you can buy. Remember the regime mismatch I started with? That's what kills 70 to 85% of retail accounts. Not the strategies, the application. A breakout system run in a range chops you to pieces. A range system run into NFP gets steamrolled. The trader who consistently makes money in retail Forex isn't running an exotic indicator. They run one strategy, on one pair, in one session window. Usually that London-New York overlap, with sizing that survives a losing streak, and they stop trading when the daily limit hits. That's the whole game. The strategies are available to everyone. The discipline is what isn't. One strategy, one pair, one session. Risk kept, journal kept. Check the description for the full breakdown.